Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. There's just an hour to go until the closing bell, and stocks are higher here as investors boost their bets for a rate cut next week following that weak private payrolls data. Let's welcome in now Inez Ferre joining us to break down all the headlines. Inez, what are you seeing in the markets?
Josh, a second day of gains for the major averages. We're watching the Dow that's up almost to 1%, the NASDAQ composite up about 0.3%, the S&P 500 up about 0.5%, and a nice pop that you're seeing in the small caps, Russell 2000 as well. We are seeing the US dollar index that has moved lower. This tends to be supportive of asset prices when this happens below 99. Just taking a look also under the hood at the sector action. Well, let's take a look at this as a transports, but the sector action here, you're seeing energy that is leading along with financials and industrials as well. Over on the NASDAQ 100, a little bit of a mixed picture for the Mag 7. You've got Microsoft that's down after that report about its AI sales quotas. You also are looking at NVIDIA that's a little bit lower. Apple that is retreating a bit, and also Alphabet. But Apple and Alphabet are both near their all-time highs. Also taking a look at Tesla, that is up about 4% right now, and Netflix is down 5%. That is dragging a bit on the NASDAQ composite. Just taking a look also over at the cryptocurrencies, you're looking at Bitcoin that is up more than 1%. A big rebound that we've seen with crypto, and it's above the 92,000 level. This is what traders had been hoping to see. If it can stay above 92,000, a run to 100,000, strategists are saying, is not off the table, but we'll have to see. Some positive developments have happened over the last couple of days. Certainly the rate cut that's expected next week is supposed to help, and also if there is the front runner for the Fed chair pick, if that comes in next month, that should be bullish for Bitcoin as well. And then just taking a look over at the Dow, that's the best performer among the three major averages. We are seeing Walmart, United Healthcare that are in the green, and also Salesforce of more than 1% expected to report its earnings after the bell. Josh?
Thank you, Inez. Well, markets pushing higher going into the final hour of trading. Investors digesting a variety of themes going into the end of the year with the AI trade, crypto swings, and next week's critical Fed decision, of course. Joining me now, we've got Nancy Tengler, Laffer Tengler Investments CEO and CIO. Nancy, always great to see you, especially on set.
I know.
Let's start with the great AI bubble debate, because I know you push back on that. Why do you push back, Nancy?
So, I mean, listen, at some point, maybe we will see a bubble. We're just not there yet, in my view. I managed money in the 90s. We had a very different setup going in. The leading stocks in terms of capital appreciation were actually experiencing contracting earnings. Our leading stocks in terms of valuation growth are generating about 20% earnings growth, the growth stocks in this whole debate. CapEx soared the entire decade. We're just getting started. So there's a whole host of other reasons, but I think everybody's making that comparison to the 90s. We were making it 3 years ago on a whole different set of criteria, but I just don't think that this is constructive because we are in the early innings.
One theme that really interests me, I'm interested to get your take on this, is how the narrative around these AI names, though, Nancy, how quickly they can shift. What I mean is, if we went back earlier this year and I talked about Google was out of favor. Like, here comes OpenAI and Sam Altman, and he's going to crush Google search. Now that stock is a rocket ship.
Yeah.
And I could have told you the same thing about Apple, right? Tim Cook, what does he know? He's got no AI strategy. He missed out on the AI capex. That stock's up 40% now in 6 months. And it works the other way. Like, we could talk about Oracle. Right? Larry Ellison, Safra Catz, they're geniuses. It's an AI must own. But then all of a sudden, I have people talking about customer concentration risk, and they've got debt worries, and the stock gets whacked. How do you invest through all that?
Yeah, it's hard. It's exhausting. We added Google. What you do is you anticipate. You try to. You do your research. We added Google 19 months ago, so we're pretty happy in our value strategy. We've owned it in growth for 4 or 5 years. We're pretty happy with the holding. I couldn't have told you that they were going to become the next AI darling, but what I did know was they weren't going to go out of the search business, and they would figure out a way to monetize AI, and they're doing that. With Oracle, I think some of this, or most of it, is overblown. It's a company that's always used debt, had a debt to equity ratio of 781% last year, growing at half the rate. It's at 500% debt to equity, growing at double the rate, with an RPO or backlog of 312 or 18 billion. Take out the OpenAI part, they still have robust growth coming. And I think that became the poster child for debt is bad, pair trade on the CDS. So we were in buying last week. Apple, we owned a little bit of it. We added pretty liberally in August, not because we thought they were good at AI, but we thought the handset trade or the smartphone trade was going to, was it iPhone 17? Wow, end of day. iPhone 17 was going to be a pretty good launch. And, I can't tell you, I don't think they are even in the game in AI. I don't know that they'll ever get in the game. They may have to partner with Google Gemini, but it is about not following the headlines, anticipating the headlines.
I get your take on this. I was listening to my buddy Josh Brown on his podcast. And Josh, and maybe I'm paraphrasing, and I might be misremembering, and if I am, Josh will text me and correct me. But he said something to the effect of, Nancy, he said, if you're picking AI winners and losers right now, Josh said, you almost have to do it with a pencil, not a pen, because things are moving so quickly.
Leapfrogging,
I'm curious what you make of that.
I think he's 100% right. There are some winners that we think we know, right? Like NVIDIA is going to continue to sell chips. Valuation is not extended. It's trading at a price earnings to growth of 0.5 times. Whereas if you think about Tesla, which is a name we like, but it's trading at 5 to 6 times price earnings to growth. Same with AMD, Broadcom. They'll probably be winners, but the shift will probably move towards software, just as it did the opposite about 9 months ago. So we want to be exposed to all of them, and hopefully around the edges we're adding at the right times and trimming back at the right times.
All right, talk AI. Let's talk the Fed too. Big meeting on deck. What do you expect to see and hear?
I think we're going to get a 25 basis point cut. You're starting to hear mumblings now about, or they might be grumblings about a 50 basis point cut. But the Kevin Hassett leak, if you will, I think was done for a purpose. The president sort of walking that back today. Well, I might, that's how he rolls. That's what he does. We thought it was Kevin Hassett. We didn't know, but we thought it was probably Kevin Hassett because he's an easy person to work with. I do know him. I can't call him.
And if it is Hassett, how do you think the market would respond?
I think it already did. I think that's why we got our rally last week, and I think it will be bullish for stocks. I'm not saying I think it's the right thing to keep cutting or have easy monetary policy, but it will help risk assets, stocks and Bitcoin.
Do you expect a cut and then a pause? Would that be what you think?
I don't know. It depends on what the data is. It looks to me like the labor market is signaling some alarm. It's just that we don't know because these numbers are so high frequency and revised so much. I don't think the labor market's in trouble myself. We're just, we saw in the ISM, so those were disappointing. Manufacturing, it was contractionary. But what happened if you dug in, production actually went expansionary, and what you saw was employment dragging it down. 67% of the companies said we're not hiring, we're just maintaining our workforce. And so that's one of the things you have to just watch and pay attention to, because if that continues, then we will see another cut.
Let's get you out of here on a couple of picks. Why is Walmart still a buy?
So it has been our poster child for old economy companies pivoting to the new technologies. They have signaled to the market they think they're a tech company by moving to the NASDAQ. But more importantly, I think what you're seeing is they are utilizing the technologies to improve delivery times. So 30% of orders are being delivered in 3 hours. 50% of fulfillment's automated. Margins are expanding. They're taking share. Yes, the multiple is lofty if you're looking backward. But if you're thinking about the future and watching the way management has been growing, this is a stock you want to own. It's in our 6 for 26.
Do you think of Walmart as just a name, Nancy, that's going to perform well regardless of the macro?
I do, because you got the low income individuals, and now you're attracting high income. I think we've talked about it. My Walmart sells Veuve Clicquot. So it's not the $50,000 a year salary that's buying that. It's the $150,000.
What about D.R. Horton?
That's just a flyer on housing. We think housing will improve, whether rates...
You do? Why, Nancy?
Because I think it has to. And I think this administration understands that. So D.R. Horton has delivered all the way through, even during difficult times, buying down, in recent times, buying down mortgages, beating expectations. The average sales price is $378,000. So it's the sweet spot of the people that need to buy homes. And they've continued to raise the dividend. I think this is the one, and Southwest, Southeast, Midwest, not Northeast, not California for the most part. So this is one of those that I think you want to own in anticipation that at some point housing will rejuvenate, and meanwhile you're getting paid pretty nicely to hang in there.
Nancy, it is always great to see you, and we're going to see you again later in the show.
Okay.
Thank you.
Thank you.
Coming up, we zero in on the regulatory outlook for crypto in 2026 and what it means for Bitcoin's price. That's next on Market Domination. Now time for some of today's trending tickers, Tesla, Oracle, and Wayfair. Going to start off here with Tesla. Shares of the EV maker rising following a note from Barclays saying the White House is considering an executive order in 2026 related to humanoid robots. Now, there are no details on what that order could say, but the analyst says it could have to do with protecting U.S. robot makers from Chinese competition. Join me now on this. We've got Brooke DePalmas. All right, Brooke, so on Tesla, we know EVs still drive the P&L, but Musk always says, listen, you believe in Tesla, it's because you believe in our AI robot future.
Yeah, and what we've been hearing all year long is really this excitement around not only this humanoid robots, but also those robo-taxis. That's why we saw a bit of a pop back in June based upon this momentum of the robo-taxis getting tested. We do have some optimism on the street about where exactly this robo-taxi could go from here. TD Cowen out with a note saying that they recently tried out the robo-taxis, that they're addressing common points of skepticism, like how far it could go and where exactly it could launch from here. And so definitely there is this optimism around Tesla really broadening its reach, especially within these humanoid and robo-taxis. But still, there is some skepticism on the street. When you take a look at the ratings on Tesla stock, there are still 16 sells, 18 holds. One of those sells on the street is from CFRA, and they did say that the potential for future products to drive sales and earnings growth longer term is really about that enthusiasm when it comes to that robotics.
All right, moving on. Let's check out Oracle as well, getting initiated with an overweight rating at Wells Fargo, so they're believers. The analyst saying Oracle is in pole position due to its relationship with OpenAI as well as its $500 billion in AI deals on the books. Oracle is an interesting one. Wells Fargo says, listen, they're emerging leader in the AI super cycle. It had this massive run, right? It was an AI winner. Then there were questions, well, maybe at customer concentration risk and debt concerns, it gets whacked.
Yeah.
Wells Fargo steps in and says it's a buy.
Right, and Wells Fargo is not alone here. We also have others on the street who are recently optimistic on the stock too. We have 36 buys, 12 holds, and 2 sell ratings on the street. And so largely, Wall Street's bullish on where this stock is going. Keep in mind, year to date, the stock is up more than 24%. And also within this AI chat, and Wells Fargo saying that, it could really lead or see this momentum around Oracle. Well, it's worth noting here that OpenAI and Oracle announced a $300 billion cloud computing deal just a few months ago. And whenever you bring up AI, OpenAI really comes into this conversation. Of course, they're behind ChatGPT. And lately, we've been talking a lot about how exactly they're facing competition from Google Gemini. Now, the CEO, Sam Altman of OpenAI, said that they really need to double down on ChatGPT, really need to return the focus there. And that's what Oracle needs as well. They really need to make sure that they're staying ahead of the competition when it comes to OpenAI versus Google Gemini.
Finally, Wayfair getting a downgrade over at Jefferies to hold from buy. So they moved to the sidelines. Analysts citing a weak start to holiday shopping, saying the company's Black Friday and Saturday website traffic was down 12% from last year. So Jefferies downgrades. They're citing this data revealing, Brooke, a clear deceleration in November visits, saying they were surprised to see web visits down from Black Friday and Saturday. What do you think?
I mean, this stock has had such a tremendous run so far this year. The stock is up more than
Yep. Yeah.
115%. And this was a company heading into the year. It's a furniture stock. I mean, tariffs were top of mind for investors heading into this year. And seeing the way that this company has continued to be able to perform in this uncertain, consumer pulling back environment has really impressed the street. And now perhaps the stock has already priced in this momentum that it's already seen. Now we're hearing a bit of a pullback at the most important time of the year. Investors not really liking that too much. Also keep in mind, something that we've been covering really closely is the housing market. If people aren't buying new houses, if they're not getting into the housing market just yet because houses are still too expensive, well, that means they're not furnishing a home anytime soon. And so that's another piece of the puzzle that needs to come into place. And that's why we're seeing a bit of a pullback today.
All right. Thank you, Brooke. Appreciate it, as always. Small cap stocks have been getting a boost as investors broaden beyond big tech, and our very own Jared Blickery covered the reason behind the move in today's Stocks in Translation.
Over the last 7 trading days, small caps have quietly run ahead of the pack, climbing above their much larger cousins in the S&P 500 and the Russell 1000 indexes. Even with mega cap tech and the chip trade coming back, small caps are starting to steal the spotlight. And this recent surge might not just be a one-off pop, as this tends to be what happens this time of year. Small caps are now positioned to ride out what historically tends to be their best 3 months of the year over large caps. And that's what we're breaking down on today's Stocks in Translation. Now, here's some basics you need to know. First, we're going to be talking about 2 different indexes, the Russell 2000 and the Russell 1000. The Russell 2000 contains about 2,000 stocks with a market capitalization or market cap of under about $4.5 billion. Those are the small caps. The Russell 1000 is like the S&P 500. It has the large and even the mega caps, only stocks over about $10 billion in market cap. And in a minute, we're going to take a look at the ratio of these 2 indexes, the Russell 2000 divided by the Russell 1000. But next, small caps often lag their larger cap cousins. But from about mid-December through early March, they've got a strong track record of doing even better. Now, this doesn't mean that history says they should be green this whole time. If they do go down, they just tend to go down less than large caps. Now, let's take a look at a chart of that ratio of the Russell 2000 divided by the 1000 over time. This is the work, by the way, of Jeff Hirsch over at the Stock Traders Almanac, and this chart starts in July and goes for 1 year. And there are 2 lines. The white line is the average of the ratio going back to 1979. That is our map. And the green line is what's happened so far since the start in July. When small caps are doing better than large, the line moves up. And when they do worse, the lines move down. Those numbers at the extreme left and right of the chart just refer to the ratio of the 2 indexes. They're really not that important. Now, notice how that green line is approaching the shaded area, which is the sweet spot for small caps. From mid-December through early March, it looks like the outperformance might have already gotten started this year, but we don't want to get too far ahead of ourselves. Now, let's call out the differences here because size matters. Small caps mostly tied to the U.S. economy, at least more so than large caps, and more sensitive to interest rates and credit conditions. And that's why they can swing harder in both directions. Large caps, on the other hand, tend to have a global revenue stream and stronger balance sheets, so they tend to hold up better during downturns and slowdowns. Small caps also tend to have less concentration risk. They're not dominated by 5 or 10 stocks the way the S&P 500 or the Russell 1000 are. But picking small cap stocks can be a tricky business, as analyst coverage tends to be lower. You really need to research what you're buying. So let's talk technicals now. In this 5-year chart of the iShares Russell 2000 ETF IWM, you can see that this is now the 3rd time that price has traded above that key 240 level, which translates to the 2400 level on the Russell 2000 index. Each breakout attempt was quickly reversed after it failed, and when we hit it in October, there was a steep sell-off again. Small caps have truly frustrated investors over the last few years, so a big test is going to be if IWM can hold that 240 level. Maybe bullish seasonality means a difference this time, but that is an open question. So here's what to watch next. First, can the Russell 2000 finally hold that 2400 level and IWM its 240 level and stay above them? These are the lines in the sand. Next, do small caps continue to outperform even with normal pullbacks? Seasonality, it doesn't mean that every day needs to go up. It just means that the odds tilt in their favor. Then, are you trading broad exposure with an index ETF like IWM, or are you trading individual names? Remember that stock picking is even harder in the small cap space. So look for strong balance sheets, and yes, that means some fundamental analysis here. So as small caps try to break out of a multi-year ceiling, they've got the seasonal tailwinds and things are already swinging in their favor. A sustained rally from here would finally break the cycle that's frustrated the bulls for years, but more frustration wouldn't be too much of a surprise either. And tune into the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
Bitcoin climbing back above $93,000, hitting its highest level in 2 weeks. Been a rough run, though, since hitting that all-time high back in October, and a key underlying factor heading into the new year, the regulatory backdrop. Joining me now is Paul Grewal, Coinbase Chief Legal Officer. Paul, it is great to see you. We've got a lot of crypto news to cover, Paul, and you are just the man to talk about it. Well, let's start with your boss, Paul. Coinbase CEO Brian Armstrong. He's at the DealBook conference today, Paul. You saw this. He says he hopes for a Senate vote soon on the Clarity Act. Let's start there, Paul. Remind us what the Clarity Act is all about and what it would mean, Paul, for Coinbase, for your business, for the broader industry.
Well, it's great to be here. The Senate is considering their version of the Clarity Act. And what the Clarity Act, which passed the House early this year, would provide for the first time is a true market structure for crypto here in the United States. Now, earlier in the year, Congress passed and the president signed a bill regarding stablecoins, which is an important first step in providing clarity and certainty under the law for crypto and digital assets. But it's really time, it's essential that Congress finish the job. And that's what it will do when the Senate finally passes market structure legislation in short order and the president signs it.
Paul, you mentioned stablecoins there. Now, Brian Armstrong also did talk about that. He said banks are exploring stablecoins after Congress passed the Genius Act. I'm curious, Paul, what does that mean, do you think, for the adoption curve?
Well, there's no question that traditional financial institutions, including banks, now understand very well the power and the potential of stablecoins to bring transformation to the financial services industry. And what it will mean, of course, is greater adoption, greater utilization, and improved efficiency throughout the financial system. We are pleased to see banks finally wake up to the realization that it's time for innovation in the way we move money around on the internet, and we're delighted to have them as partners in this space and look forward to their full participation.
Now, Paul, it wasn't just Brian Armstrong, your colleague at DealBook. We had Larry Fink there too. There's another big name. He said Bitcoin, that was interesting, he said Bitcoin remains heavily influenced, Mr. Fink says, by leverage players. And I'm curious what you make of that, Paul. I mean, how much risk does leverage sort of still pose here? And how does Coinbase mitigate that?
Well, Coinbase has provided access to Bitcoin for millions of Americans, really going back to the earliest days of crypto. But it's a market like any other market that evolves with time, and it's natural to expect that individuals who may have been less familiar or even less comfortable custodying their own Bitcoin and holding it in their own wallets would want to rely upon intermediaries of all types in order to fully participate and finally participate in this market. We are seeing leverage and additional intermediaries relying upon leverage introduce new options for consumers to participate in the Bitcoin revolution. And that, of course, will require there to be new standards, new requirements, and new safeguards put in place. But we think that the market structure legislation is key to facilitating that. It will define for the first time which assets are subject to the securities laws of the U.S. and which assets fall outside of those laws. And we think that concerns regarding leverage and many others are best addressed by Congress and the agencies charged with writing rules once Congress acts.
Switching gears, Paul, another big headline in your world. You saw this one. Vanguard will now allow crypto ETFs on its platform. Curious, Paul, what did you make of that headline? What does it perhaps signal to you more broadly about crypto as an asset class? Why do you think, Paul, Vanguard did an about face there?
Well, Vanguard, like many others, I think initially was skeptical of the power and the potential of crypto to fundamentally transform the financial system and financial institutions that operate within it. And yet I think it's finally become clear to all skeptics that millions and millions of Americans want crypto in their financial future and want real alternatives to a traditional system that has excluded many of them for far too long. And so if skeptics, at least initial skeptics, are finally waking up to that realization and eager to join the party, we say welcome.
Finally, Paul, you all did release the Coinbase Transparency Report. I want to dive into that with you as well. Here's a stat that jumps out, Paul. You all saw a nearly 20% jump in government information requests this year, and more than half coming from outside the U.S. Walk me through that jump, Paul. What explains that? I mean, I would assume it's sort of, it's multifactorial, but is that greater adoption, Paul? Is that, hey, law enforcement, both here and overseas, is getting more sophisticated? What's going on?
Well, our transparency report that we shared earlier this week was, in fact, the 7th report Coinbase has issued detailing the volumes and the sources of all the legal process to which we have responded over the previous year. And it is, I think, pretty striking that we now have a majority of those formal requests from law enforcement coming from outside the U.S., even as volumes, as you point out, are continuing to grow in every jurisdiction. I think it's quite natural and quite expected that as many more people, not just here in the United States, but all over the world, are embracing digital assets and cryptocurrencies as a part of their financial future, that law enforcement, in support of governments all over the world, are naturally going to be looking at where, in limited instances, those accounts or those currencies are being used for illicit purposes. We've always taken the position that our customers' privacy comes first, and so we've insisted upon lawful process, but when we are served with it, we will, of course, comply with all laws, and I think our report shows that.
Finally, Paul, I'll get you out of this as we kind of spin ahead, as we look to next year. I'm just curious, Paul, what are some of the metrics you all watch to sort of track and measure crypto adoption? I'm just curious, what's on your radar? Do you watch, is it ETF flows, Paul? Is it stablecoin volumes? What would be on your radar?
Well, it's very, I think, tempting to focus entirely on the price of Bitcoin or some other digital asset or another, or the total market value for all digital assets. But at Coinbase, we are as much interested in the ways in which crypto is being used to power our financial future as much as the dollars and cents of it all. And what we are most excited about is that you're now seeing digital assets and blockchain networks being used to solve many more problems than simple investment opportunities for our customers and for users all over the world. You're seeing real alternatives being made available through DeFi applications, for example, for credit. You're seeing adoption of digital assets to offer many more forms of payment and many more ways to transfer value across the internet. And so it's that real acceleration and adoption of different forms of digital assets and blockchain networks that has us as excited as much as anything. And we're prepared for it, we're excited about it, and we're delighted to see this vision of ours finally come into reality.
Paul Grewal, thank you for your time, sir. Appreciate it.
Thank you. I appreciate it as well.
Coming up, we have Goodbye or Goodbye with Nancy Tengler. We'll hear how she feels about 2 chip names. That's next. Welcome to Goodbye or Goodbye. Our goal here, to help cut through that noise to navigate the best moves for your portfolio. I'm here now with Laffer Tengler Investments CEO and CIO. That would be Nancy Tengler. Nancy, great to see you. We'll start, Nancy, with one you like. It's a crowd favorite. It's AMD. Now, we should know, this one, look at that chart. It's up about 80% in 2025. Phenomenal run. Most on the street, by the way, still like this one. You do too. Let's walk through some of the reasons why. Your first reason, it's the C-suite, exceptional leadership and execution. Walk me through it.
Okay, Lisa Su joined in 2014. 0% market share in CPUs, 41% share now. When she went to the board and said, I want to be in the AI business, she had overwhelming support. I want to work with a CEO or be an investor alongside a CEO that has vision and can execute.
Remarkable run. The second reason, strong growth outlook.
Yeah, so at their investor day recently, they gave guidance for 80% data center growth, 35% revenue growth, and earnings are expected to grow next year at 64% with a PE that's below 30. So you've got a price earnings to growth ratio of about 0.5 times. That's pretty low when you're buying a growth stock. So we think valuation and growth are there, and that's why one of the reasons why we like it.
Your point being, even after an 80% rocket ship, valuation still attractive.
Yeah, and it's come down, on all the worries about AI bubble, debt, OpenAI. So it's down 20%, giving those who missed it a chance to get in.
Third reason, you say this is one you'd commit capital to, position for the AI shift to inferencing. Explain that.
Yeah, so they've got a great lineup in inferencing chips. The training chips are really NVIDIA's sort of bailiwick. We're shifting now, and they're going to be introducing the M1450, M1450. That's an inferencing chip. I think this is really going to just be a tailwind to the company's growth rate, and they've counseled 30 to 40% growth for the next 3 to 5 years.
All right, you made your case, Nancy, convincingly and eloquently as always. But of course, we have to remind people, before you pile in, what are some downside risks you got to think about?
Yeah, it's the AI trade. I mean, if by chance we're in a bubble, this would be one of the stocks that would get hurt. You saw the sell-off last month. That was around that, just some people taking profits. I think you just want to pay attention to, is AI continuing to grow? Is there a shift in sentiment or guidance from the management team?
All right, so you say buy AMD. Now we have to talk about one you'd avoid. That'd be TXN. This stock has gone basically nowhere this year. I mean, it's actually in the red in 2025. Let's go for the reasons why you say, you know what, I'm still avoiding this. Slowing dividend growth signals slowing confidence.
Yeah, so we used to love this name when Rich Templeton was the CEO. It was return all free cash flow to shareholders. Dividend growth was in the double digits. They bought back shares. He left and then came back, a little indiscretion in the C-suite, so he had to come back. And they just haven't regained their mojo. So they've reduced dividend growth, which tells me they're less confident about future earnings growth.
Second reason you say this one is still one to avoid, guidance cut and slower recovery.
Yeah, so they just reported, they cut the guidance for the fourth quarter, and they basically said that their customers are waiting on the sidelines. So, juxtapose that against what you're seeing in the AI space. It is a reason to have caution.
Final reason you're steering clear, you say customer hesitation and weaker growth profile.
Yeah, I mean, just more of the same. So their customers are not building their respective factories. And remember, this is a company that's industrial, automotive. We haven't seen a lot of growth in manufacturing in the country, and we haven't seen a lot of growth in the auto business. So they are experiencing slowdown. Now they've reduced inventory, so that has put them in a at least decent position, but slow growth.
Finally, Nancy, let's ask you, how could you be wrong on TXN?
If the economy were to come roaring back, and it may, and you start to see auto companies, producing demand for autos going up, and the industrial space growing, the old economy industrial space, this name, because they've reduced inventory, will experience, I'd say, pretty rapid earnings and margin growth, and you'll be collected. But in the meantime, if you own it, you're collecting the dividend. So, if we see that, we may go back in.
For now, buy AMD and avoid TXN. Nancy, always great to see you.
Thanks,
Thank you
Josh.
so much. And thank you all for watching. Goodbye or goodbye. Meanwhile, don't go anywhere though. We've got you covered with all the market action ahead of the closing bell. That's coming up next. President Trump announcing changes to federal fuel efficiency standards as gas prices are now sitting at 4-year lows. The national average hovering just below $3 per gallon. Here with more, senior markets reporter Inez Ferreira. Inez.
Josh, and as you just mentioned, the national average for gasoline is sitting at that 4-year low. The price at the pump on Wednesday hovering just a hair below $3 at $2.999 per gallon. Meanwhile, roughly 30 states already seeing prices below that $3 threshold. You still have the western states that have higher taxes and fees on driving fuel. So the average, for example, in California is still at around $4 $3.50 per gallon. But when you get into the Midwest, the Great Lakes area, down in the Gulf Coast, prices at the pump are well below the $3 threshold. Some stations are even seeing $1.99. That's something that the Trump administration has been touting in recent days as Trump ran his campaign with the promise of lower gasoline prices. The drop in prices has to do with refineries which have finished up their maintenance and the price of oil that has fallen this year as crude producers have been increasing output. Analysts say that barring some type of catalyst, you can expect prices to fall further going into the holiday season and into January.
Before we let you go, the outlook for gas prices next year, 2026, Inez, what are the pros saying?
So it's even lower. You've got the EIA that has the national average for 2026 at $3 per gallon. This year it was $3.10. Last year it was $3.15 or $3.30. So it's gotten lower and lower. Next year you are going to see prices going lower if oil production continues to be similar, or it has been rising. OPEC has been rising its oil production. They put a pause on it, but it's expected. I mean, you're looking at oil prices. The street is expecting Brent crude to go below $60 per barrel for oil for next year.
Wow. Inez, thank you. Appreciate it. Well, Apple shares on track here to snap a 7-day win streak, but this under-the-radar rally has some investors looking for ways to play the tech giant. Join me now, we've got Jessica Inskip, stockbrokers.com, Director of Investor Research in the Options Pit, sponsored by Tasty Trade. Jessica, it is always great to see you. So let's talk about Apple, Jessica. I mean, what a story for 2025. Earlier in the year, Jessica, it's out of favor. They've got no AI strategy. What does Tim Cook know? No, I think I remember some analysts even suggesting maybe it was time for a change in the C-suite in Cupertino. Now spin ahead, that stock's up 40% in 6 months. But what's the trade on the iPhone maker, Jessica? What do you see?
Yeah, absolutely. When we see a stock like this that's making all-time highs, a lot of time individual retail investors especially, we feel like we need to time the market. We got in too late, or whatever that fundamental or even technical reason may be why we like the underlying security. So the way that we can utilize this with options is by creating an obligation to buy the stock, and we can do that by selling a put or a cash secured put. So essentially we would sell a put. It creates an obligation where I have to buy the stock at the strike price at any time through that expiration period. But in exchange for that obligation, I collect a premium. And the premium really acts as a buffer, or this range that you can create where you put time on your side. So essentially, first-time options traders tend to buy stocks outright or buy calls for their first options trade. When you do that, time is working against you. You actually have negative theta. Positive theta occurs when we sell an option and we're putting time more in our favor. So it's less about timing the market and more about creating this window of time or a time frame and a cushion.
Do you consider, Jessica, a trade here, like the one you're outlining, is this a good trade for, a relative newbie? Like if I'm just getting my feet wet in the options market, is this a smart trade?
Yeah, I think it's a great trade for the first-time options trader. And oftentimes when you're a first-time options trader, you end up buying options rather than selling them. And once again, it's when you can put time on your side. So for example, the way that I'm constructing this one, I'm going 45 days out because an option is derived from the underlying security. So in this case, Apple, it has different premium components. We have to consider implied volatility, so a likely movement. We have to consider the time frame when it expires. So by going about 45 days, I have more in that premium that's excess based rather than just on the underlying security. So I'm going out 45 days so I can maximize basically that decaying. My strike price I'm choosing is very close to the money, which means it's very close to the current price of the stock, which is $285. I'm collecting a premium of about $6.75 per share. That was earlier today. I checked before I hopped on and it increased $1, so it's almost $8. But what that does now is I am creating an obligation to buy Apple at $285 per share. And I have that obligation for the next about 44 days. And I collect $6.75 per share in exchange for that obligation. And basically, I've created this range. Think about the chart. If we look at Apple around $285, if I go up 675, that's about 291. That is my upwards range. But my downwards range, and really my break even, is that premium that I receive of 675. My obligation is at 285. But since I already collected 675, my break even is 278.25. So essentially, for a first time options trader, we are utilizing the same risk as buying the stock outright, but we're reducing that risk by the premium received. So we're slowly introducing that options component aspect. I like to think of it like a limit buy order. When we're putting in a limit order to buy a stock, or Apple in this case, you would still set aside your cash within that limit order. But in this case, we're setting aside our cash that if it hits, that obligation kicks in, we're going to have to buy the stock. However, I'm getting paid while I wait, and that's the difference here.
Finally, Jessica, before we let you go, we talked Apple there, but I just want to get your thoughts, bigger picture too. I mean, how should investors think about the potential of the options market as 2025 draws to a close? Jessica, how do you want to be positioned here?
Yeah, so I love to throw a top-down approach with all of my investing and looking at the macro as well. I think when we look at options, we tend to, as individual investors, look at the market in two dimensions, which is up and down. When we add options, it's actually path. We have a third dimension because now we have strike prices and we have an expiration date. So a price and a destination and a time frame. So we can utilize the options market, even if you don't trade it, as purely analytics to understand investor sentiment. And we can gauge certainly a lot from that if you're bullish or bearish. So from the overall macro picture though, and pairing that with what I look at as an individual investor and from an analysis perspective, it is a challenging market that we have right now. I feel like we've hit a ceiling of resistance or very close within the broader markets, and we're really waiting on the Fed to cut interest rates. But are those interest rate cuts going to come because of the upside risk to the labor market, or unemployment rather, is higher? And that could bleed into your micro and your individual securities. They could sell off within sympathy. So it's really important to think about your macro view and how the micro fits into that overall as well.
Jessica, great as always to have you on the show. Thank you.
Yeah, thank you.
Let's get a quick check of the markets heading into the closing bell here. We got gains across the board as the weak ADP report has investors now betting a rate cut is definitely coming next week. We're also waiting on results from Salesforce. That's coming after the closing bell here, and the stock is rising into that print. We're wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.